Welcome, everybody. Today is April 11. We will be live, I believe, the rest of the month, just to have a little look ahead. The big economic news, without a doubt, is Russia loosely tying the ruble to gold. That was the focus of the podcast and radio program this week. That is the focus of the Portfolio Watch newsletter. And that's the focus of what I want to talk about today. So I want to give you an in-depth look at what's going on, but more importantly, what the implications might be. So today I want to talk to you just about the background and how we got where we are. So I want to talk about the move. I want to talk about the counter move, which was Russia's move to link the ruble to gold, at least loosely. I want to talk about what this move might mean for the U.S. dollar, and I want to talk about what Alistair McLeod has to say about the possible implications. He put out an article this past week that I was lucky enough to get some of his time and interview him for this week's podcast. Ruble is now gaining strength against the U.S. dollar, gaining strength at a rapid pace, and I'll talk to you about what was being said about the sanctions a month ago and what the reality is now. And there are more inflation signs as inflation continues to build. I will share with you some creative ways that some businesses are dealing with this. So let's start with the move. And as I go through the material today, if you do have a question or a comment, on the right-hand side of your screen, there's a type your comment box. Please go ahead and just type any comment or question you have in the type your comment box. I'll be monitoring that as we go through the material today. So this article has a headline, U.S. effectively freezes Russian central bank assets held by Americans. Freeze on transactions of Russian central bank assets is effective immediately, senior official says. The U.S. said it is blocking financial transactions of Russian central bank assets, effectively freezing any of those assets held by Americans. The freeze is effective immediately, and I should point out this article comes from February 28th. So it's about 6 weeks ago. This freeze is effective immediately. Again, that was 6 weeks ago. A senior administration official said in a briefing for reporters on Monday. The official said that the U.S.'s actions are in conjunction and cooperation with the European Union, Japan, the UK, Canada, and others. This means that not only will Russia not be able to access funds in U.S. dollars, they'll be unable to use the dollars other countries use to deal with Russia. By making the move effective immediately, before markets open, the official said, Russia will be unable to move assets to avoid or mitigate the consequences. Our strategy, the official said, is to make sure the Russian economy goes backward as long as President Putin decides to go forward with his campaign. Now, it didn't take long, about a week, and Russia said, okay, our U.S. dollar assets you have now effectively confiscated. And incidentally, as a side note, from the research I've done, that has never happened even in wartime. And we are not officially at war with Russia at this point. So yet, all these Russian assets held in U.S. dollars were confiscated or frozen. So Russia responded. And Zoltan Pozar commented on the response. And this is a great way for me to cover it on today's webinar. Mr. Pozar formerly worked at the New York Federal Reserve. He was an advisor at the U.S. Treasury, and he's currently a strategist at Credit Suisse. And he wrote a research report about the move and the counter move, as I'm calling it, that he called Bretton Woods 3. Anyone familiar with the Bretton Woods Agreement understands the reference. So the Bretton Woods Agreement initially tied the U.S. dollar to gold in 1944. Mr. Pozar said Bretton Woods 2 is when that link was eliminated, and you all know that was in 1971. That at that point in 1971 is when the currency went from being backed by something tangible like gold or arguably a commodity to being backed, as this article says, by the sovereign issuer's full faith and credit. So this post-71 fiat currency reserve banking system that was enabled by the removal of gold is nothing more than a Ponzi scheme. Inside money refers to the interbank repo and lending mechanism from which the fractional bank reserve monetary systems blossomed. So inside money is fiat money. Now, Posar in this research report talks about the difference between inside money and outside money. Inside money is created by the central bank. $1 of reserve currency can turn into $9 more of currency because money is loaned out. And now to take that a step further, through quantitative easing, currency is just created literally out of thin air. The point is that even this initial dollar of reserve capital is not backed by anything. It's backed only by the full faith and credit of the issuing entity. This currency is essentially debt. So the author of this article, Dave Kranzler, said, you want to think of this monetary system as an inverted pyramid. In bankruptcy law, full faith and credit would be considered at best an unsecured loan. You get in line and you pray there's value left over to be distributed to the unsecureds. In contrast, Posar references Bretton Woods 3, which is this recent action by Russia to tie their currency to a commodity. He calls this the rising allure of outside money over inside money. Outside money is money backed by something. It's backed by some type of collateral. It's exchangeable for collateral or tangible stuff. So outside money is backed by real stuff, tangible stuff. Inside money is money or currency created by the central bank. Now, Kranzler makes a really interesting point here. He says that in periods of banking crises, banks are reluctant to participate in the inside game. This happened in 2008. It happened in September of 2019 because at that point in time, they don't trust their own. They're reluctant to lend money to their banking peers because they don't know if they're going to get it back. They don't fully trust the fiat currency. Every time this happens, what do central banks do? Well, if banks won't loan money to each other, I guess we'll have to print some more currency so that the financial system continues to operate. So central banks, the Federal Reserve in the case of the United States, they create more currency to, as Kranzler says, so they can lubricate the system so that it continues to operate. But that action just simply serves to further devalue the inside money on which the system is based. If currency issued by governments and printed by central banks is backed by hard assets, you don't have this problem. The currency is not devalued. In this system, the counterparty to trade or financing transactions would have the option of saying, hey, I don't think I want the currency. I think instead I want the hard asset. So Kranzler said it's really likely that Putin knew ahead of time that if Russia invaded Ukraine, the West would likely freeze Russian currency reserves held at central banks. As a response, Russia is now requiring any unfriendly country who wants to buy vast Russian resources or energy to use gold or rubles to purchase this particular, these assets, these resources from Russia. So Russia is now saying, we don't want the inside money, we want the outside money. You've got to pay for it in gold, and we want you to deliver the gold, or you can use rubles. They don't trust dollars anymore because all the dollars they held have now been confiscated. So Kranzler said what we're likely seeing right now is the beginning of a reset of the global monetary system. Russia now has China's support, and any countries which supply the world with goods like oil, natural gas, and food commodities will now have the power to enforce trade settlement in hard currencies. And that's exactly what's happening. Now, Alistair MacLeod, who I had a chance to interview on the radio program this past week, has a very lengthy article about this that he titled The Commodity Currency Revolution. Now, I would encourage you to go to goldmoney.com and go to the insights section of the site to look at this article in its entirety. But I want to give you Alistair's take on this because I've interviewed Alistair approximately every 4 months or so for the past 2 years. And what is actually happening now is something that we've discussed in our past interviews as being an inevitable outcome. Well, now that inevitable outcome that we discussed is actually occurring. Now, Alistair said this to start off his article. He said, we're going to look back at current events and realize that what we're seeing now marked the change from a dollar-based global economy underwritten by financial assets, or we'll call it inside money, to commodity-backed currencies or outside money. He said, we face a change from collateral, the backing of the currency, from being purely financial to becoming commodity-based. And it's collateral that underwrites the whole financial system. It's what backs the currency. He said, the ending of the financially based system is being hastened by geopolitical developments. The West is desperately trying to sanction Russia into economic submission, but really what they're doing is drive company influence against them. I think we see that if you've been to the gas store, that's exactly what's going on. I was talking to someone over the weekend that is in the tire business, and they told me that the price of tires on a wholesale basis is rising from 5 to 8% every 2 weeks. You know, tires obviously have some petroleum component. So central banks, according to Mr. McLeod, said central banks are going to have no options but to continue to print, continue to create currency, to continue to inflate their currencies in order to pay for these higher costs. However, Russia has now linked the ruble to commodity prices through a moving gold peg. China has stockpiled commodities and essential grains for the last 2 years and allowed the yuan to rise against the dollar. China and Russia are not going to go down the path of the West's inflating currencies, the euro and the dollar. Instead, China and Russia, as we have talked about many times in the past, are now moving towards a sounder money strategy with the prospect of stable interest rates and stable prices while the West accelerates in the opposite direction. So Pozar, who we talked about in the prior article written by Mr. Kranzlers, calls this Bretton Woods 3. So McLeod now talks about how will we all be affected? How are we going to deal with this financial inside money system now potentially being replaced? And we don't know the pace at which it will be replaced, but now we're seeing it replaced with outside money. So McLeod says pure finance is being replaced with commodity finance. It's a terrific way to phrase it. McLeod correctly notes that it hasn't hit the mainstream media yet. The mainstream still reporting yesterday's battle. But in March, the U.S. administration passed a death sentence and on its own hegemony in a last desperate throw of the dollar dice. Not only did it misread the Russian situation with respect to its economy, but America mistakenly believed in its own power by sanctioning Russia and Putin's oligarchs. Now, Mr. McLeod he lives in the UK. He's looking at this from a British perspective. So the consequence now, McLeod says, is a final battle in the financial war which has been brewing for decades. You don't sanction the world's most important source of energy and the marginal supplier of a wide range of commodities and raw materials without damaging everyone but the intended target. Anybody that wants Russian oil, Russian natural gas, Russian grains, or fertilizers that is considered to be unfriendly, which would be most of Europe and America, now has to have rubles or gold. China, McLeod notes, is a really powerful friend of Russia. And this China and Russia combination is 40% of the world's population. This is not a small number. Despite this enormous hole in the sanctions net, McLeod notes, the West has given itself no political option but to attempt to tighten sanctions even more. But Russia's response is devastating for the Western financial system. They've tied the ruble to gold. Payments for energy will only be accepted in rubles, and the rubles can be exchanged for gold. And Russia is now calling for an end to the fiat dollar era that's ruled the world from 1971 to today. Mr. McLeod notes also, and I've not been able to verify this from another source, that Saudi Arabia is now taking Chinese yuan for the sale of oil. I have not seen that. I know there were talks taking place, and I've not independently verified that from another source, but I certainly have a lot of confidence in what Mr. McLeod would have to say. So 5 decades ago, McLeod notes, gold was the reserve asset. The dollar then replaced it as the reserve asset through a deal with Saudi Arabia. After the 70s, McLeod notes, which was a decade of currency, interest rate, and financial asset volatility, we all settled down into a world of increasing financialization. Well, what does that mean? Currency devaluation that has really accelerated from the early 80s all the way to the present time. McLeod notes that we saw all this really culminate at the Lehman failure. That was at the time of the financial crisis. And since that time, quantitative easing, or currency creation from thin air, has been the monetary policy du jour. So now we're seeing all this coming to an end. Russia, as I noted, said you've got to pay for energy in rubles, not in dollars, not in euros. So they're directly challenging this dollar's role as the reserve currency. And if you want to buy energy from Russia, you've got no option. Now, if you live in the European Union, and I believe there are 13 countries in Europe that get 65 to 100% of their energy from Russia. So the question is, through summer, they may drag their feet a bit, but by the time the heating season kicks in, where's their allegiance going to fall? You're going to have populations that are going to want to stay warm. So these countries are going to be forced to go out and get rubles and inventory rubles, and that will be more attractive than inventorying dollars. McLeod notes the European Union, which is the largest importer of Russian natural gas, either bites the bullet or scrambles for alternatives that will be insufficient. They're going to have rubles. So McLeod says no matter what they decide to do, it seems that Russia wins and the EU is going to lose. Now, he comments on Posar's argument here that we're on the verge of Bretton Woods 3. We're seeing a currency again tied to a commodity, to a tangible asset, and McLeod agrees with that particular assessment. But he makes another point here. He said all central banks in the West, whether it's the European Central Bank, whether it's the Canadian Central Bank, whether it's the Federal Reserve here in the United States, any of these banks that have indulged in QE or currency creation have the same problem. Rising interest rates are now here, and the only way to deal with that is try to create more currency or go directly to a reset. So Putin has copied essentially what Nixon and Kissinger did in 1973. Saudi Arabia in 1973 said we only take US dollars for oil payments. Russia has now said we only take rubles, creating a petro-ruble and potentially replacing the petrodollar. So you've got the West, which would be America, the European Union, Britain, Japan, South Korea, have all set themselves up to be the fall guys, according to McLeod. By phasing out fossil fuels before they could be replaced entirely with green energy sources, an enormous shortfall in energy supplies has arisen. Germany has been cutting out nuclear generation, and as recently as last month is still ruled out extending the lifespan of its nuclear facilities. The entire G7 membership were not only unprepared for Russia turning the tables on its members, but so far they don't have an adequate response. So Russia has effectively commoditized its currency. They've now backed it by something tangible, particularly if you're buying energy, gold, or food from Russia. China is doing something similar. So the dollar's dominance has now been challenged, and McLeod says perhaps this has been fatally challenged. He said it's interesting to observe the strength in the Mexican peso against the dollar. The Mexican peso is up 9.7% since November. The Brazilian real up against the dollar 21% year over year. The South African rand has risen by 11% in the last 5 months. That these flaky currencies, to use McLeod's words, are rising tells us that resource backing for currencies has its attractions beyond the ruble and the renminbi, which is the Chinese currency. So if you take a look at the US dollar index in this week's Portfolio Watch, you see the US dollar index is pretty strong, but it's important to remember that that US dollar index does not measure the absolute purchasing power of the dollar. It only measures the relative purchasing power compared to the 6 currencies of the 6 major trading partners of the US. Americans and the rest of the West have turned their backs on gold. McLeod says that's why they don't have an adequate response. He said, if anything, they're likely going to continue to fight for dollar dominance rather than accept reality. And the more America struggles to assert its authority, McLeod says the greater the likelihood of a split in the Western Partnership. Europe needs Russian energy desperately, going back to my point that this alliance might hold together for summer months, but by winter, it probably looks a bit different. McLeod says Europe cannot afford to support American policy unconditionally. And he said that, of course, is Russia's bet. Now, he goes on to talk about the fact that when the Western actions started, when the sanctions started, the Russian ruble declined significantly against the dollar. In fact, this chart shows that it got cut really in half. Once the link happened between the ruble and gold, and Russia will now buy gold from Russian banks at a rate of 5,000 rubles per gram. So it is a direct link to gold. And McLeod makes an interesting point that priced in gold, crude oil prices haven't moved. So if you look at the gold gram chart on the bottom, you see really in gold, the price of oil hasn't changed since 1950. However, priced in the British pound, the US dollar, or the euro, it's higher only because these currencies have been devalued. So Russia, according to Pozar, according to McLeod, Russia now is using gold to stabilize the ruble. Now, there's not a fixed rate. It's a fixed rate for a period of time, and Russia will periodically revise the price it will pay for gold after July 1. So it's 5,000 rubles per gram for gold now. That number can be adjusted by Russia periodically. They'll change the peg, but it will still be redeemable for gold. Now, the ruble crashed to a record low of 121.5 per dollar shortly after the Ukraine war began. In fact, President Biden tweeted that the Russian economy is on track to be cut in half It was ranked the 11th biggest economy in the world before this invasion, and soon it will not even rank in the top 20. Well, that's really not happened because Russia's counter move, tying it to gold, solved all those problems. And if you take a look at this chart, it shows that the ruble fell in half, the ruble recovered, and now it's actually exceeded its pre-war valuations against the US dollar. And the main reason for this, obviously, is Russia tying their currency to gold. So Brendan McKenna, who is a strategist at Wells Fargo, talks about the fact that these sanctions won't work. He said, in order to stabilize a currency, you have to have a current account surplus. You need to have a trade surplus. If energy prices remain high and major importers of Russian energy and commodities continue to purchase, Russia will have a surplus and they'll be able to have more staying power than those that need the energy. So big news. This is bigger than probably anything we've seen since 1971 when it comes to currencies, and we will continue to monitor this. One of the things I would point out to everyone is if you don't have 20% of your portfolio or so in tangible assets, now is the time to do that. I believe that before this year is out, the potential is quite high for gold and silver to go higher when priced in terms of dollars. Now, Peter Bokvar talked about this. I thought it was interesting. I'm going to close with this week. He said, companies are going to do what they can to recapture lost profit margins due to higher labor and raw material costs. Put another way, companies are going to do what they can to recapture lost profits due to inflation. He said, I was at a restaurant in Boston Saturday night and I found a kitchen appreciation fee on the bill. This was followed by a friend's trip in Brookline to a bagel store the next day, which included a 10% fair wage surcharge. He makes a great point. These very inventive, these imaginative ways to increase bills to help offset rising inflation, those don't show up in the consumer price index calculations. And here is the bill that he received from the restaurant. You can see that he had some, looks like some wine and a Caesar and a bowl of clams. And at the bottom is a kitchen appreciation fee of 5%. Here's the bagel receipt. And you can see at the bottom, there is a 10% fair wage surcharge, adding $2.75 to the $24 charge for a baker's dozen of bagels. So this is the new world in which we live. We're now seeing definite movement to a currency with tangible backing. I wrote about this back in 2011 in the Economic Consequences book when I talked about this currency money cycle. And we're now seeing the beginning of this movement back to a money system, a monetary system that's backed by something tangible. I expect that this move will continue to accelerate. I don't expect we'll get there extremely quickly, but I expect it will continue to move in that direction. So we'll continue to monitor this. We'll continue to give you some thoughts about how to navigate this crazy world in which we live. And I appreciate everyone getting the word out about these webinars. Hope they're helpful. And Mark, I'm not seeing any questions, so I'll hang out for a minute and see if there's a question or not, but that's what I have to cover today. Here we go. Dennis, for a 401k asset in ETF gold, is there any option to moving something to something safer? So, yes, I guess I would say this. There is an exchange traded fund that still has a link to gold. My sense is if that link or that exercise option begins to be utilized, that will probably be suspended, given that we now have a pretty big disparity between the paper price of gold and the physical price of gold. So my suggestion would be to consider, if it makes sense in your situation, I would think about getting a self-directed IRA and buying physical gold. And then another question, does the Okay, it's in a Fidelity employer account. So if you're able to roll the money out of the 401k into an IRA, you can then have a self-directed IRA and buy the physical metals. So Jack, that would be what I would consider. If you want to call the office, I'm happy to schedule a time to chat about it as well, and maybe walk you through the steps, or someone here can. So yeah, I would be looking at physical gold here. Another question from a viewer: does the 20% gold holdings include gold exchange traded funds? I think along the same lines. When possible, I would want to be in physical metals. You know, the exchange traded funds may make sense because there are storage fees and reporting fees when you own physical metals that total about $250 a year. I would want to make sure that you had at least $25,000 that you owned in a self-directed IRA to justify the fees. So a gold exchange traded fund, if you have one that still allows you to redeem the shares for gold, and to my knowledge, there's only one, that can make some sense, but physical gold is still better. There is no counterparty risk, and I wouldn't limit my holdings to just gold. I would own gold and silver for most people. Good questions. Mark, I think that's everything. We can go ahead and conclude. We'll be back again live next week.